Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help us make smarter trading decisions. And in today's video, we are going to uncover a highly effective super scalping strategy that can transform the way you approach the short-term trading. This strategy is designed to help you capitalize on quick market movements with precision and discipline, making it perfect for those of you looking to maximize opportunities in fast-paced environments. Stay with me until the end of this video because I will break down everything you will need to know, from the exact tools and the indicator to use. So we are going to see a step-by-step instruction on how to make use of this strategy, on how to execute this strategy. Now, what is super scalping strategy? Super scalping is a trading strategy that focuses on taking advantage of small price movements in the market over a very short time frame. As traders, your goal is to open and close multiple trades within minutes, aiming to accumulate small but consistent profits throughout the day. This approach requires precision, quick decision making, and a solid understanding of the market's behavior. Scalping works best in highly liquid markets where there is enough volume to ensure smooth trading execution. For forex trading, this usually means focusing on major pairs like the Euro USD or the GBP USD, which offer tighter spread and high volatility, two key factors that make scalping efficient. This strategy heavily relies on technical analysis using indicators to identify entries and exit points with accuracy. You typically work with the 1 minute or the 5 minute chart, which allows you to monitor price movement closely and react quickly. When scalping, while scalping can be rewarding, it also demands discipline and strict management rules to avoid losses from sudden market reversals. So that's why I have the 5 minute chart on my screen. So let's look at a step-by-step guide to execute the super scalping strategy. To execute the super scalping strategy effectively, you need a structured approach that combines the right tools for clear entries and exit rules and disciplined risk management. So let's break this down step by step. We start by setting your chart to your 5 minute time frame or your 1 minute time frame. Next, you add an indicator, which is the EMA, the exponential moving average, using two lines, a short period of 9 EMA and a longer period of 21 EMA. This is my setting for my EMA, 21 and 9. You can also use this indicator to help you identify trends and potential entry points. We can also make use of the Stochastic Oscillator. This measures momentum and overbought and oversold conditions, giving you an edge in timing your trade. So these are the two indicators I'll be using for this strategy. The second step is to identify your entry signals. How do you identify your entry signals? For a buy trade, you wait for the smaller EMA, which is this blue line. The smaller EMA is this blue line, the 9-period EMA. You wait for the shorter EMA to cross above the larger EMA. When the smaller EMA, the blue line, cross above this yellow line, which is the longer EMA, it signals an uptrend. You also confirm your stochastic oscillator moving out of the oversold zone. That is, it has to be moving out of or moving above the 20 level on the stochastic indicator, because below 20 is an oversold zone. So once it's going above the 20 region on the stochastic, it means that we are going into an uptrend. for a sell signal, all we need to do is wait for price. We wait for price, or we wait for the shorter EMA to cross below the longer EMA, meaning we wait for this blue line to cross below the yellow line. The blue line signifies the shorter EMA, the yellow line signifies the longer EMA. So this is what we are looking at in chart. We also look at the stochastic oscillator moving out of the overbought region, which is moving out of the 80 region. It moves out of the 80 region, meaning it's going out of the overbought zone. Only enter when both conditions align to increase your chances of success while trading this scalping strategy. The third step is to always place your stop loss and take profits. You have to manage your risks with critical steps in scalping, since trade quickly happens while trading this strategy. Always set a stop loss just below the recent support level for a buy trade and just below or above the resistance level for a sell trade. For take profit level, always aim for a risk to reward ratio of 1:2. This ensures that even if some trade fails, your winners will outweigh your losses. How do we exit trade? Now let's practicalize this. When I see my confluence is aligned, when I see my shorter EMA crossing above my longer EMA, and I see the price is moving out of the oversold region from the stochastic indicator, I would take my trade when price come back to retest the line. When price comes to retest, I put my stop loss just below a resistance area or below the last swing low. This is a resistance area in chart. You can put your stop loss just below this area on the chart. In case of a sell trade, you put it just above that region. Your take profit should be 1:3 or 1:2, as the case may be. Quick exit is essential in scalping to lock in profit and to minimize your losses. Now let's look at some common mistakes we need to avoid while trading this strategy. While the super scalping strategy can be highly effective, there are some common mistakes that can halt your results. Let's go over some of these mistakes to avoid them. The first one is over leveraging your account. Using excessive leverage might seem tempting to amplify your profits, but it can also amplify your losses. So you have to always stick to a manageable position size that aligns with your risk tolerance. The second thing we need to avoid while taking this trade is ignoring the market condition. Scalping works best in a volatile and liquid market. All we need to do is avoid trading during a low volume period or when the spread are wide, that is during the holidays or during a major news event. This is when you need to avoid trading. Then the last mistake we need to avoid is over trading. Taking too many trades in a short period can lead to emotional decisions and unnecessary losses. Always stick to your strategy and only trade when a clear signal aligns with itself. Alright traders, we have come to the end of this video. Do well to engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.